Good morning, everyone. Welcome to our February CGBN webinar. I hope you're all doing fantastic today, even though it's super chilly outside. Before we begin, please know that this session is being recorded. To ensure a smooth experience, we kindly ask anyone who is not presenting or part of the panel to mute themselves and turn off their video recording. Our session today will run for an hour and a half. We'll start with presentations, followed by the Q&A segment for each presenter. Once the Q&A concludes, we will end the recording and transition into our needs and wants segment. If you have listings or trade missions to share, please let us know. We'll be happy to feature them on the CGBN page. After today's session, the recording will be available on the CGBN YouTube channel and the CGBN page. In the meantime, please take a moment to share your information in the chat, including your email, name, phone number, and any needs or wants you'd like to address. For those of you who may not know me, my name is Dimitro Lockman, and I'm the current chair of CGBN, and I also serve as the president-elect for NICAR. Dr. William is the vice chair for CGBN, who is going to be taking over for me later this year. In the meantime, I'd like to take this opportunity to express my sincere gratitude to our past CGBN chairs, Ahmed Badat, Teresa Mueller, and Bill Caden for their invaluable contributions and support. Thank you for all joining us today, and let's get started. Today's webinar is called Exploring Canadian Commercial Real Estate Trends in Ontario and Alberta. I will introduce Sharon von Schoenberg, who's BCom CIPS CAE, Associate Director, Global and Commercial Programs, the Canadian Rea Estate Association, CREA. So Sharon is a key leader in shaping global and commercial engagement at CREA. As Associate Director, she drives initiatives that align with CREA's strategic priorities, empowering realtors with knowledge, resources, and business opportunities worldwide. With a focus on fostering strong industry relationships, promoting best practices, and exploring innovative programs, Sharon plays a vital role in enhancing the realtor ecosystem. She also represents CREA in a broad network of real estate organizations, both in Canada and internationally, reinforcing the value of collaboration and connection in the global marketplace. Sharon, it's all you.
Great. Thanks so much, Dimitro, and to Bill, Ahmed, Teresa, and the whole NICAR team for having us here this morning. It's a chilly one here in Canada as well. I'm zooming in from Ottawa, Ontario. Couldn't get out my front door. I don't know if that was a record snowfall in a few number of years, but we do love the white stuff up here. But anyhow, we're happy to be here, and I'm super excited to have two of our commercial realtors with me today, Raymond Chan and Bob Shetty. So I'm going to start things off. I'm going to start my share. It always takes a moment. So Dimitro, maybe once you can see my main PowerPoint, it will take a moment. You can let me know.
The screen, okay.
You should see the screen. And hopefully.
There we go.
Awesome. All right. So the show's on the road. So thank you again for that wonderful introduction. I'm with the Canadian Rea Estate Association. And as I mentioned, I'll start things off today. And I'm going to first introduce my two co-presenters. And then I'll share a little bit about CREA and a little very high level about commercial real estate. And then I'm going to pass it over to Raymond, who's going to chat a little bit more about Canadian commercial real estate, Ontario. And then he'll pass the baton over to Bob, who will round things up in the West with Alberta. So as mentioned, we've got Raymond Chan and Bob Shetty. Raymond is a managing director at Warwick Realty Group in Toronto and specializes in mixed-use investment sales in the Greater Toronto Area with a focus on healthcare. Prior to founding Warwick Realty Group in 2019, Ray was a commercial real estate broker at CBRE on the capital markets team, working with private investors in the hotel and retail space. Before making the switch to full-time brokerage, Ray spent over 10 years at a Canadian bank where he held progressively senior positions in trading commercial banking real estate group and in real estate risk management. Ray earned a master's in business administration degree from Warwick Business School and an honors Bachelor of Arts degree in economics from the University of Toronto. In addition, Ray is a facilitator at Humber College and teaches the commercial real estate transaction course. He currently serves as a director at large with the Toronto Regional Real Estate Board and is vice chair of their commercial committee. He also serves as an advisor on CREA's commercial advisory group. Bob is an award-winning commercial real estate agent with over 23 years of experience in Alberta, specializing in the Airdrie and Calgary markets as investments, multi-investments, industrial properties, retail spaces, and office real estate as where he focuses on selling and leasing. While his primary business is in the major markets, Bob's expertise, extends to towns in Alberta and beyond, having completed transactions as far as Pincher Creek and Red Deer. And I'm sure he's going to share where that is because I'm not even sure. But Bob is dedicated to understanding his clients' needs and providing exceptional real estate experience. And he's also a member of CREA's Commercial Advisory Group. And both are here to share highlights from what's going on in their market. But as I mentioned, we're all representatives of the Canadian Real Estate Association. CREA's head office is here in Ottawa, Ontario. We have over 160,000 members coast to coast, and we operate through 63 real estate boards and associations. Similar to the US, CREA members are part of a three-tier system, if you will. So to be a realtor, you typically have membership in your local board, provincial board, and then national association. CREA works on behalf of our members to advocate to the federal government on legislation that'll affect members or impact home ownership in Canada. We work to enhance members' professionalism and ethics through various products and services and through national standards, including the establishment of symbols of quality associated with using CREA brands and trademarks, such as the Realtor brand. We produce up-to-date information and analysis on economic issues and housing stats, and we own and operate Realtor.ca on behalf of members. Realtor.ca, not to be confused with Realtor.com, is the #1 portal for Canadian real estate listings. Currently, we have over 250,000 active listings on the portal. That covers residential, commercial, for sale, and lease. We've seen an increase in our commercial listings there of over 38%. And roughly 9% of visitors are international visitors. And in 2024, there were over 121 million visitors to the site. And as mentioned, roughly 9% of those were international, and our #1 international visitor is from the United States. We also conduct a national member survey every year, similar to the National Association of Realtors. We look at international activity in the Canadian market. So I thought I'd kickstart today with a short, it's about 1-minute video that highlights our survey, our 2024 survey. So here we go. Let's see what it has to say.
In the dynamic world of real estate, there's no denying both buyers and sellers share an appeal for thinking globally. What does the Canadian international real estate landscape currently look like, and what are they looking for? CREA's recent International Real Estate Survey shows the majority of Canadians seeking property internationally are doing so for vacation homes, residential investment opportunities, or both. However, international buyers are looking at Canada mostly to purchase a primary residence. Originating from all corners of the map, international interest in residential properties was highest from the United States, China, India, Hong Kong, and France. The top 5 Canadian destinations were Ontario, British Columbia, Alberta, Quebec, and Nova Scotia. And the average international sale price was above the general market's average. Thinking commercially, businesses continue to make strategic moves during uncertain or challenging economic times. When it comes to international real estate, it's clear Canada continues to play a significant role. Grow your business. Go global. Learn more at CREA.ca/global.
So just a little sneak peek there. Again, that's member reported, and we're currently in the field right now with our member survey. And so look forward to having an update to that in the spring. But I just pulled a couple of slides out around the commercial information. So top countries, international buyers are from on the commercial side. Again, as reported by our members, China, United States, Germany, India, South Africa. And of course, the main segments of commercial real estate, a couple of stats there as well, just to start the flavor off. I'm going to now introduce Ray, who's going to take over. And just a reminder, if you want to hold your questions till the end, we'll have lots of time to answer questions on all of our presentations. So Ray, over to you.
Great. Thanks so much, Sharon. And I just want to start by saying the most stereotypical thing I did yesterday was shovel my snow. So that was almost an hour and a half of hard shoveling. So again, not to play up the stereotypes, but it does happen in Canada. So good morning, everyone, and very happy to be here. Thank you so much for the introduction, Sharon. So where does it stand? I think 2025 Canadian commercial real estate, I want to start off by saying that there's definitely more similarities between our markets than differences. So looking at it from, I guess we'll start very macro high level of talking first about Canada and then Ontario, and then I may get a little bit specific in terms of some of the cities in Ontario, but I'll try to keep the first part high level. So from a retail, office, and industrial perspective, basically what you're seeing in the States, we see here from a cap rate perspective, right? And so certainly we have the same types of investments that you would see on a retail side, and very similar from an office perspective, we have different classes in terms of our buildings as well. So cap rates tend to be very similar to what you would see, probably for retail about 4 to 5. Office, depending on how far you get from the core, maybe in some of the suburban markets, you might even see somewhere between 5 to 7, right? And I think that's very similar to what's seen nationally in the States. Industrial cap rates tend to be slightly higher than the global average, primarily because most of our industrial properties are owner occupied, and not so much from an investment perspective. So, and very similar to the U.S. Land development in Canada, we've actually got lots of land, so lots of room to grow there. And just to give you some high-level numbers just about Canada, our population, while nowhere near as sizable as the U.S., we're about 40.1 million in terms of a population. In Ontario alone, we're about 16, and Toronto, so where I'm from, we're at 2.8 million. So we're basically tied with Chicago. And I know this is a US based call, so I want to say we're tied with Chicago for our 4th largest city. So moving on to the next slide. Tying all this together is our transportation network. So, our transportation network spans land, sea, air. And just to give you some context in terms of the level of trading partner that Canada is on a global basis, and annually moves about close to 1 trillion worth of goods to and from Canada, so into the international markets. And this is all supported by a very vast transportation network. Looking at the next slide here. So now we're going to, jump down to Ontario and take a closer look at the province that I'm from. So province, very similar to state. So from an economic perspective, Ontario's commercial real estate market is definitely poised for some dynamic growth in 2025. But again, we're not immune to many of the things that you're experiencing, whether it be from an interest rate perspective from the government or any sort of other inflationary fluctuations, and not to mention changing U.S. and Canada policies. These all play into our economics for 2025. So again, it's going to be very dynamic, but some of the things that we are looking to see in Ontario, continued economic employment growth. From that perspective, we, as you've seen in that video, we are one of the top destinations for newcomers to Canada. So we're expecting particularly strong growth, continued in traditional urban sectors such as Toronto and Hamilton. If you may be familiar with some of the southwestern cities in Ontario. We're looking at infrastructure development, so more work being done to our highways, public transportation, and we do have several smart city initiatives. All these are contributing to long-term economic stability, and I think from an investor perspective, despite the headwinds that we have locally here, confidence is high in Ontario, and in terms of Ontario to be that economic, diverse and stabilizing population. So I think this is probably, under investor sentiment, a good time to even just mention as well the exchange rate. And I know in one of our preparatory calls we had talked about it, but since and this rate is as of I guess last Friday, February the 6th. Actually, no, sorry, this rate is as of February the 16th. So 1.35 is the current exchange rate. So for every dollar you have in American dollars, that gets you about roughly 1.35 Canadian dollars. And as I mentioned, from a cap rate perspective, if we're trading in very similar cap rates, it almost means as if things are about 30% off when you look at it from that perspective, from an exchange rate perspective. And to give some context, the last time rates were kind of hovering around this level probably would have been the early 2000s when it was around 1.3 to 1.35. We saw some stabilization in the 2010s to about 1.2 to 1.25, but certainly from a historical perspective, it seems like we're back into that 1.35 range. So certainly while a weaker Canadian dollar may attract a foreign investment, we are not immune to potentially economic slowdowns due to possible trade tensions with the U.S. So, that could offset some potential investment gains. But at the same time, I think what this does is it at least plants the seed for potential exchange rate appreciation. So looking at the next slide, we're going to dive into a bit more of a specific sector now. So when we look at industrial real estate, the GTA, so the Greater Toronto Area, as I mentioned, where I'm from, vacancy rates remain extremely low. And though we do have somewhat high construction costs, land scarcity has certainly slowed down the speculative development. So the majority of the properties being built in and around Ontario, for the most part, are being built on spec. I think the approach is still, because we haven't quite nailed down rates at this moment. At this point in time, a lot of developers and investors, they're waiting to build it and taking a build it and they will come approach because rates are so hard to price, and certainly if you do end up getting that industrial lease, as many of you on this call will know, once you do have an industrial tenant, they're in likely for 10, 20 years at a time. So that base rate is critical to establishing how profitable an investment will be. So I think what has happened in turn is that it's just created an economy where businesses are coming, but after the shell is built. So they're doing a lot of the fixturing on their own. So as mentioned, average industrial lease rates in Ontario are expected to increase moderately, and probably as demand stabilizes, we'll start to maybe move from that build it and come approach to, okay, so now all of a sudden we're building for a specific group or a specific business again. And so looking at new development, although it has slowed in previous years, there are certain surrounding areas such as, and this is very specific, I don't expect anyone on this call to know where these places are aside from Toronto maybe, Mississauga, Brampton, Vaughan, Hamilton. These are all becoming very much seen as the, I guess in the US they call it the last mile type warehousing facilities, where a lot of infrastructure is being put in to help with getting products to consumers. Okay, retail. So from a retail perspective, investment in Ontario's retail sector remains strong with the traditional leaders, such as those with grocery anchored, high street retail in urban centers, as well as the development of more mixed use properties that integrate both the retail, office, and residential components. One really big one to look up is the Well in Toronto, which is spearheaded by spearheaded by a condo developer, a REIT, and as well as a office property REIT as well. So you've got a lot of key players now investing in one property, each focusing on what they do in terms of their strength to bring about these mixed-use properties. So you have that, as well as, from a consumer perspective, consumer trends, just more experiential retail. So again, I think I want to highlight that this actually is certainly something that is that started in the States, and this will lead to another point I have further down. But like what you do see is a lot of trends that happen in the States eventually make their way to Canada and Toronto specifically. So certainly the experience from that perspective is something to look out for. As well as market resilience. So high population growth, suburban expansion, and continued urban development support a positive outlook for retail. And so I want to kind of make a connection, and hopefully I'm getting this right, but Kitchener, Waterloo, Hamilton. These are all areas in Ontario, southwestern Ontario, where we've seen new opportunities for expansion. They're all in and about, I'd say, an hour and a half commute to Toronto. So, and I want to make that comparison. So, is it similar to Aurora, Naperville, and Elgin in Chicago? Would that be somewhat of a good comparison, at least from a distance perspective, right? So what we're seeing is people move from the city into these neighborhoods, and then by doing so, they're bringing with them sort of their comforts, right? So retail being one of the things that they're bringing first and foremost. Looking at office, so we do have, office is certainly still recovering, I would say, from post-pandemic, and our vacancy rates aren't great. I think I'll put it to you that way. Pre-pandemic, we were low single digits. Currently now, we're probably sitting in and around, as a province, probably exceeding about 14%, and certainly higher in certain urban nodes. Again, during the pandemic, a very unique thing happened in Toronto, specifically, is that there was all this new construction for these very brand new and modern buildings, leaving a lot of existing Class A offices to have to worry about where their tenants are going to come from. So that's really been what's driving a lot of the sustained vacancy in the downtown core. And not to mention things like hybrid work, right? Where you're still working towards just coming in a couple days a week, not fully yet on a Monday to Friday schedule. These types of hybrid work impacts have certainly played a factor into the vacancy, and will probably continue to do so for the next couple of years. I think what's going to be very interesting is this year in particular, being 2025, there's quite a few office lease expiries coming up, and whether or not those businesses decide to continue with their footprint will be a key thing to look out for. And so if I can make a comment on the market sentiment, certainly there are strategies that again we're looking at and probably paying very close attention to from a U.S. perspective, because there's been a lot of office to residential conversions, and certainly gaining traction in certain municipalities. I can say from a Toronto perspective, that's something that's being looked at, but just because of a lot of zoning and other governmental and municipal issues, things haven't happened as quickly as I think they might in other cities, but definitely something to look out for as we go through this year and looking into next year. Okay, so next we have multifamily. Transaction volumes in Ontario are increased as well, with the investors capitalizing on the strong rental demand. As mentioned before, lease rates all across the board seem to be moving in a certain direction, and that's up, thankfully. And a lot of this has to do with the expanding population of Ontario. So with that population, not only is there work that's in demand, but also housing. So rental rates continue to push upwards, making this an attractive investment for developers. And certainly too, I think with these developmental trends, what we're seeing now more so in Ontario is purpose-built rental. So these are gaining a lot of momentum. I think throughout the 90s and early 2000s, condos were sort of what was pushed from a development perspective. But what we've seen probably in the last couple of years is just a return to developers saying, hey, rather than build an asset and sell it, why don't we just hold on to these assets and become sort of landlords ourselves, because the cap rates are so favorable from that perspective. So that shift in multifamily has started to happen. And then if we take a look at what's next. All right, so some key trends in Ontario. Sustainability. So certainly green building certifications are increasingly prioritized by tenants and investors, not just from it's the right thing to do, but also from a demand and from a perspective that net zero developments and carbon neutral building initiatives are the way of the future. So certainly that, as well as if we talk about and just even prior to this call, we were talking about AI, right? Technology integration, the Internet of Things, enabled building systems. All these things are popping up in commercial real estate in Ontario. So certainly something to look out for. We've got land development from a government perspective, where government policy is supporting transit-oriented developments. So again, these would be the cities that I mentioned that are about an hour and a half away from the Toronto core. These are gaining more interest in terms of from a development perspective, and also too just finding different ways to intensify urban nodes, right? So in terms of intensification, we've got and this is not commercial real estate, but just housing in general. So you have your traditional home on a lot. They're now allowing, from a new municipal perspective, to add additional buildings and structures to that lot. So if you can picture a lot with a primary residence on one, and then they're building what's called a garden suite or a laneway house, to add additional income potentially, but also to define housing in these established neighborhoods. These are things that municipalities are looking to integrate more and introduce more. And so next we have investment appeal. Ontario certainly remains a top choice for domestic and international investors due to, I guess, its economic stability, but also not to mention its workforce and strong market fundamentals, again, led primarily by the influx of people coming into the city. Government initiatives, provincial policies supporting infrastructure growth, public transit, and increased housing supply bolster long-term investment potential in Ontario. So that's all I have to say about trends. I know since this is a commercial group, we might as well just get into some cap rates because that's what we all like to do. So industrial cap rates, we're looking probably about 4.25 to 5.25. Retail 5 to 6.5. Office, again, slightly higher for secondary markets. You could get up to 7 cap, and that is, traditionally a very stable asset, right? And especially if you look at the growth pattern and where the economy is headed, potentially picking up a office building in a secondary market, could prove to be a very good long-term investment. Multifamily, 4 to 5.5 is what we have here. I'd probably argue in some markets because it's such a sought after investment, it's probably maybe sometimes sub 4. Really just depends on the area. Okay, and so I'm going to kind of not skip over. I'm just going to talk very high level about this because I don't want to take up too much time, and I know Bob's probably already very excited to talk about his stuff. But Ontario investment highlights, certainly, we do have some key sort of trophy transactions that happened in the last quarter. So you can take a look there. But just to give you some context, even that multifamily portfolio that you see in front of you, the one for 300 million Canadian, that's about 600 units. So if you can do the quick conversion, 300 million is probably only about 200 million US. And so, you're looking at 600 units for 200 million. See if that makes sense in your market. But one other sort of specialty that I want to talk on was just the healthcare side, right? So healthcare real estate certainly is very hot at the moment in Ontario, and only because there's a major REIT, so Northwest Healthcare Properties, they actually took an initiative to streamline a lot of their investments. So last year they actually sold 12 properties. So the properties itself, probably for the 12 of them, somewhere in the neighborhood of 165 million Canadian. But what that means is that there's actually an opportunity for people to enter this market, right? So if you're looking at it from an investment perspective and something from, say your clients are interested in diversifying their portfolio and they want a stable economy to grow into, something like Ontario would then present that opportunity, right? Looking at it from a portfolio perspective. So again, these are some key highlights for Ontario. And if I can just finish off with just some high level comments, right, about what I see happening. Basically, trends that you see happening in the States eventually make their way to Canada, right? So as mentioned before, that industrial real estate boom and last mile logistics, that's something that certainly started in the States and has now come to Canada, right, in most major cities. So whether it be Toronto, Vancouver, Calgary, Montreal, all these centers are influenced very heavily by the likes of Amazon, the likes of Walmart. So if you think of it, again, from an investment perspective, it would make sense to start investing in these types of industrial facilities. The conversion of office spaces, again, a U.S. influence as well. And actually, I don't know if Bob's going to talk about it, but like Calgary is already actually leading, I think, in this regard, right? So Calgary does have a downtown revitalization plan, and something that I wish Toronto would look at or consider, because that certainly makes a lot of sense given the amount of vacancy we have in these office buildings. And I think lastly, probably the one piece that I think is really telling of where this may go is the institutional investment in rental housing. So that I understand that's very big in the states, especially in the southern provinces, or sorry, southern states. We have provinces, you have states. In your southern states, all around, there's a lot of I guess influence in terms of what's being purchased from a rental housing perspective, and so that in and of itself is presenting opportunities, because I think Canada and especially pension funds are looking at potentially entering into that market as well, because it is stable and it is long-term growth in the rental space. So that I think is probably all I have to say in terms of things US that may happen in Canada. And I don't know if now is the time to talk about tariff risk, but you know what? I might as well. It's only going to take a minute. I think tariff risks just present trade uncertainty, right? So the same sort of things that disrupted our economy during the COVID times, supply chain disruptions, as well as having to both for the U.S. and Canada adapt internally. I think those will be some of the challenges that we'll face if this tariff risk continues to escalate. And I'm not going to get into any more political than that, but I just think that it's that uncertainty, the supply chain disruptions, as well as what other strategic adaptations they'll have to make. That's going to prove challenging for this year, and hopefully that's it. Okay. Bob, over to you. I know I talked a lot, and hopefully within my allotted time limit, but again, there's a lot going on.
Perfect. Thanks, Ray. Yeah, Sharon, if you want to just flip through to the first slide. So when I was putting this together, I was skiing in Japan. So that's the only snow photo I have. If you could flip past that one. And flip one more. So Calgary and Edmonton, they're both the major cities in Alberta. I just wanted to highlight a couple pictures of them. It's very beautiful places in the summertime. There's certainly places where the residents love to live, work, play, but driven a lot by oil and gas activity. The reason why these cities have existed the last 50 years is mainly due to the oil and gas industries, and then spin-offs from there. Just next slide there, Sharon. The one beautiful thing about real estate out in the prairie provinces is that we get high cap rates. And so I grabbed this slide. We've always sort of been at the top of the country for cap rates, and up at the 6.5% for the third quarter 2024. Next slide there, Sharon. And so just some highlights on our market and the different segments in our market. So office, we do have, as Ray was mentioning, we do have that downtown office conversion grant program. So the government is offering $75 a square foot, up to $15 million per property. They just increased the total amount that they're putting towards this program. I'll get to that in another slide. And it's spurred on an absorption of vacant spaces, making Calgary's quarterly absorption the strongest in Canada due to the conversions and accelerated leasing. But despite these gains, vacancy remains pretty high in the Class B and C spaces. We're still at about 24%, down from a high of 32%. And ongoing conversions should gradually reduce that overall inventory and improve the overall vacancy rates. In the AA vacancy for office, you're at 12.04%. So that's still, it's manageable at this point compared to where it was at the peak pre-pandemic. And for industrial in Calgary, there's a slight vacancy increase driven by new vacancies and recent developments, but there's still pretty high demand for small and mid-sized bay properties. Large warehouses and logistics centers are still super strong. Where the vacancy rate in Calgary, 3.91% ending in the year, so still really healthy for industrial. Retail vacancy rates 4.3% as of December 2024, and it was 5.2% previously. So obviously heading in the right direction. And then multifamily, we have a so the real estate market in Calgary, the residential real estate market has grown substantially. So price gains of just under 12% year over year. And because of that, there's putting a lot of pressure on multifamily. Also developers that originally started buildings, like Ray was saying, where they intended on building product for resale, they've now converted those just into rentals. My assumption with that is probably both great cap rates, but also they'll gain some appreciation as prices increase over time, and so makes sense just to hold the property as an investment property in the short term. Let me just get this onto there. And then, so for Edmonton, if you can switch to that slide, Sharon, so the office market in Edmonton, overall vacancy rates better than Calgary, 18.4%. The industrial vacancy rate, 3.17, so still very healthy. It was 3.06 the previous year, so we're still got great numbers there. Retail in Edmonton is 2.8%, and just really strong demand in the last quarter of 2024. And then multifamily, it's arguably the brightest sector in Edmonton. The high population inflows, I've got another slide on that, from both international and interprovincial sources has caused acute housing shortages. So we don't have rent controls in Alberta, and we've had some pretty healthy rental rate inflation in both Calgary and Edmonton. And so cap rates can be seen as low as 4% for really high quality product, but you can get great cap rates otherwise. So next slide there, Sharon. This is on that office conversion program. They just increased the total amount of funding by another 52 million. So it's 150 million total. And it's a really exciting program. It's paid upon completion. The government will give you a letter of guarantee to begin with, to help with financing and converting these buildings. And typically people are converting the B and C class buildings. So really smart of the municipality to start on that. I just wanted, on the next slide, to give you a couple of really simple investment opportunities. This is on the low end, obviously. You can buy a commercial condo bay, 400,000, 7.5% cap rate, and the $344 a square foot. So quite a substantial decrease from what we see in Vancouver and Toronto. Just quite affordable, and obviously great cap rate. And then pure triple net. A lot of our condos, the tenant would pay the entire condo fee, so there'd be absolute net other than mortgage to the landlord on that one. And then in the next slide, we've got an apartment building. So just to give you a sample, this is an apartment building in decent condition, but not it's 40 years old, and 131,000 per door, 6.5 to 6.75% return, and really healthy investment for someone. There's a MLI Select program which puts a lot of pressure on the market for owners to amortize over 40, 50 years, and so still a lot of demand for these buildings. The property, although it takes a month or two for due diligence, probably gets 6 to 10 offers within a week. So, and then on the next slide is I just wanted to show the audience about really what's happening in Canada. The interprovincial migration. Oh, sorry, there's some kind of something on the slide there that covers up the BC. You're not missing anything there, but on the bottom left-hand corner, it says interprovincial or international net migration. So 96,000 people from outside of Canada moved to Alberta in the last year, and then 8,300 moved from BC to Alberta, and then 14,000 moved from Ontario to Alberta. And really what's going on there is it's a flight to affordability. So the BC and Ontario markets have had such a great run over the last 10 years. And, in terms of residential housing, the average prices would be over $1 million in each area. And you can, for $600,000, you can get a beautiful property in Alberta. A lot of people that are moving actually are selling their, $1.5, $2 million properties and buying a $600,000-$700,000 property in Alberta and retiring or, harvesting that money for investments for retirement. So sorry, that slide didn't come through properly. And then where to look for properties in Alberta. So if you just wanted to do some search on the next slide, we've got Realtor.ca, which is obviously the Canadian Real Estate Association website, and then Spacelist.ca. Between those two websites, you really do get 99% of the properties that are available on market, and really give you some healthy statistics to zone in on a certain segment of the property. We've got a few submarkets that are really healthy. In good times, they do very well, great cap rates and low vacancy, and then they suffer a little bit in the when there's a little extra vacancy. So I can talk through anybody on that offline if they need. And then the next slide. So just a little talk about my thoughts on the tariffs. I agree with everything Ray said. I think that if the tariffs go through and it affects lumber, then there'll be an increase in construction costs. If it affects the metal, obviously the steel buildings, the industrial buildings will go up. But if there's continued rise in construction costs and we have the continued net migration, it's just going to put further pressure on existing properties. There'll be less new construction, and we feel like there's still room to go in affordability for all segments, I guess, of the real estate market, including residential. Of note, we've had a few deals fall apart. One was a big car dealership deal, and just making people nervous, not knowing what's going on. So in the short term, there's some turbulence, but I think it'll work through long term. And then next slide is just like Ray was saying, we're 70 cents on the dollar, so certainly a big advantage for anybody bringing their down payments from the U.S. And then my next thought I just wanted to highlight: in Canada, we have a foreign buyer ownership ban on the residential side, and so that's put a lot of pressure on the commercial side. So typically, if foreigners were bringing money into Canada, they found a safe place to invest their equity from another country. They would purchase residential or commercial properties, and now there's been a flight to commercial just because of this ban. It's just been extended another 2 years to January 1st, 2027. And then some more differences on the next slide. Obviously, if you've never invested in Canada before, we don't have attorneys, we use lawyers, we don't have escrow, the law firm does the conveyancing. There's some differences in the interest rate, interest compounding. So in America, I understand it's mostly monthly versus mortgages would be semi-annually. And then we're noticing cheaper interest rates in Canada, and we have a really secure title system. A lot of question I get from American clients. And that's all I had.